I feel like I got a piece of fuzz stuck on a whisker here. It's weird. Welcome to Season 2, Episode 7. It's knowing your worth, valuing your worth. We're going to talk about valuations today. If you're just joining me for the first time, my name's Brad Hogan. I'm a business guy here in Central Florida. We're just here to talk about business, getting going, what it takes, going all in and risking it all to make yourself successful. Valuation. It's something that we hear it on Shark Tank. We hear it all the time. What's it mean? And how do I value my own worth to the company? How do I value my company? How do I value a company or something I'm looking to buy? How do I value a manager that's starting in my company? We're going to unpack some of this stuff today. What is valuation? Well, the valuation is basically your assets minus your liabilities. That's what the value is. What I'm not going to dive into deep, but touch on, you'll hear some of these terms, a PS ratio or a PE ratio, profit versus equity. What's that mean? What's market cap? What's all that stuff mean? Let's talk about some of the big stuff, just kind of get that off the table. Most of you out there are not General Motors or Tesla or P&G, Procter & Gamble, but we hear these terms. For most of us, we want to grow our small business. And what's that mean? Very, 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 very quickly, I can take a company from startup to 50 million. How do we get there? And as some of you know, I just came out of a situation. We started at $3 million. Went to 52 million, took 4 years, 7 months, sold for 25 million. What's that look like? How's that done? What's the valuation? How do we get there? How do we get profitable? I'm going to grab some current information here. Let's talk about Tesla. Tesla is a company we know, call sign TSLA. It's traded on the NASDAQ. They closed yesterday at $166.52. So $166.52 per share. That's what that is. That's what that represents. And then number of shares outstanding, 3.166 billion. What's that mean? So 3,166,000,000, etc. And we won't go lower than that. Let's just take that and multiply outstanding shares by value, which is share price. And what do we get? We get 527.2 billion. Okay, 527.2 billion. That's the market cap. That's the valuation of the company. You'll hear people on MSNBC or whatever you tune into. You'll hear the talking heads or somebody appearing on the show saying the company's overvalued. What's that mean? They're saying the earnings in relationship to the stock price, it's overvalued. We could talk about those ratios. If I'm looking for a growth stock, I want a P&E ratio, profit divided by earnings, of 30 or higher. Get into that in another segment. I'm not a stockbroker. I'm not an attorney as far as valuation of your company goes. And no, that's not a disclaimer. I'm just telling you, when we get to that point, we need to consult the right people, okay? Anything below 30 on a P&E ratio may be more stable, but the opportunity for growth is not there. I would encourage everybody, get a valuation on your company no matter where you're at. And in the startup in the beginning, that's fairly easy. I mean, what am I worth? I'm worth zero. I haven't sold anything, or I'm just starting to sell some stuff. What's the value of my company? Profit versus valuation. And I got this question. And the question is valuation the same as profit? And it's an excellent question. Profit measures what has happened in the past. Revenues and your expenses, revenue minus expenses, is going to give you your profit. Going forward, the value is measured by the current business and future profits. Maybe you've seen the show Shark Tank. I want to talk about it right here in that many times I see people that come into the Shark Tank and they will say, well, this is a multi-billion-dollar industry and I've got a value of $800 million because of, what can happen. And it's an unrealistic picture. Number one, you're going to hear this from any astute business professionals on top of their game. Know your numbers. Know your numbers. Know what your income is. Know what your expenses are. And have a future projection that's realistic. It's a growth path. How are you getting there? In other segments, I talked about business plan, talked about marketing, etc. Well, one of the things within that plan is what I project to do, and I do projections on my business every year. It's ironic, we're in 2023 right now. People ask, so what's 2023 looking like? What are you expecting? Are you planning for 2023? I already know what's going to happen in 2023. I'm looking at 2024 right now. I'm planning for that. I'll make some adjustments. Everything I'm talking about affects the value of my company. What do the projections look like? What do my expenses look like? Revenue, expenses. It's going to give me a future valuation of my company. Here's why that's really important. We know that as we scale, as we grow, we scale this thing up, our margins are typically going to shrink. The reason for that, in simple terms, today I'm working out of my home, I'm working out of my garage. Maybe I've got a partner, a brother, a spouse that is helping me. I've got no real overhead. I don't have a warehouse. I don't have a retail location. But as we scale, we say, hey, this thing's too big to run out of the house. It's too big to run out of my garage. I need a warehouse. Oh, I need a warehouse manager. Oh, now I need a production manager. Now I need a VP of production, a production manager, a scheduler. We start adding all this overhead and our margins start to shrink because money's going to overhead. I want to keep an eye on the valuation. If my valuation's the same here as it is when my revenue's up here, what am I doing this for? What's our goal? Need to know that when you start and need a clear path on where you're going. When somebody comes in to buy a company and it's a small company, it's typically an asset purchase. And what that means is we've got the revenue minus the liabilities gives us the profit, but the asset is really that future growth, what we're getting ready to do. And I'm not talking about plant and equipment asset. I'm talking about valuation of the company. We'll call that an asset purchase. I'm starting up my company. How do I value myself or my partner, my manager, someone I'm bringing into the business? I own some other businesses. Obviously, I can't run them all on the day-to-day. I bring someone else in. How do I value that person? Very key, very important. Very important for me. And if you're an entrepreneur, you need to hear different ideas on how we do this. So I bring in a manager, say, hey, I want to make you president of this company. You're going to run it. Let me ask you a question. What does a manager for a company like this get paid? Do some research. So they come back and tell me a manager in this position gets paid $72,000 a year, gets paid $120,000 a year. And I go, okay, we've got no revenue today. So I'm not going to pay you 120. I'm not even going to pay you 72. What do your expenses look like at home? I mean, let's make sure you can pay your bills. And then let's work something out to where you can really be profitable. So my offer is I want you to make a lot more than the 120. Let's give that opportunity. That's in the future. That's why they'll stay and that's why they'll work their butt off and do this. I'm going to guide them on the back end. And I'm the guy that's worried about valuation and all that kind of stuff. But what is the value of that person? What is my value in the workplace? What we're talking about here. We're going to figure out a scenario where we can pay them $3,000, $4,000 a month plus a commission going forward. And then as long as they stay in the company. They can't come in and tell me they're quitting tomorrow, they're going down the road to work for somebody else and still own part of my company. I can't allow that to happen. So we've got to put that in an operating agreement. But what's going to happen here, and I talk about ownership structure in some other videos, but what's going to happen here is we're going to own this business. Maybe we own it 50-50. Maybe we own it 60-40. Whatever the split is, doesn't matter. But their pay, their compensation, whether it's commission or salary based, that's an expense to the company. And then whatever profit is left over, if we're 50-50, we split it. Here's what that looks like. Let's say my manager gets paid $5,000 a month with their commission, etc. They made $60,000. That's what they earned as income. And then at the end of the year, we split the profit. And there's $100,000 to split. They're going to get $50,000. I'm going to get $50,000. So they now walk away with $110,000 and the opportunity for more growth. That's what keeps them in there. What you need to do to value yourself is, what is the marketplace? And I think sometimes we don't know our own worth. We don't know our own value. And sometimes we overestimate our value. Perhaps you're not overestimating your actual worth in the marketplace, but perhaps in that situation. Here's what I'm talking about. That manager comes in and says, well, this job pays $120,000 a year. Well, you're not getting $120,000 a year in this startup. I'm not paying you that. The money's not there. I would be at a loss for years to pay out that kind of cash. So we've got to get to another opportunity. I mean, do I look at Jamie Dimon that runs Wall Street and say, well, he made $50 million last year. I mean, why can't I make $50 million? I'm a CEO too. Well, different deal, different situation. You're running a different valuation of a company. There's the key. We're talking about valuation, and your manager or yourself, you're managing a company. What's the valuation of your company? And that's going to tell you a lot about the compensation. Rather than someone coming in saying, oh, these people make this or that, and that's what I need to be paid. Well, a small business can't pay you that. Maybe General Motors can, but the startup at home can't pay you $1 million a year starting out. It's not going to happen. Let's talk about what we offer employees in a startup, and it could even be ourselves, but basically I'm talking about when we start to grow and we're bringing someone else in, how we do that relative to the valuation of our company. So I think a very, very, very common mistake is offering a percentage of the company. I see this on Shark Tank all the time, and it's common that I'll give you a percentage of the company for. Why are we not offering shares or warrants in the company? If you're offering a percentage is forever. Perhaps to get a shark, they're not going to go for that. But if we look at Google, Facebook, any of the tech startups, those people have shares in the company. Microsoft, when it started up, their shares equal some percentage, but they didn't give away, hey, you can have 10% of the company if you'll help me. No, they give the employees shares, and as the valuation grows, their net worth grows. Does that make sense? So we've got shares in a company that's publicly traded, etc. We've got warrants in a company, warrants versus shares, and that's a company that's not traded yet. You've just got some value within that company. Very popular within the tech startups. You're going to get a sign-on bonus. You're going to get your salary, and then you're going to get shares within the company. Let's look at other models that are successful, and let's model after them. Today, you may not be as appealing as Google or Facebook or name one, Microsoft, but there is some value in your company. And I know the sharpest business guys here in town around the country, they actually are using, and I modeled after them, they're using some of these things I'm talking about. You come in, you can be president of my company, you're going to run it, I'm going to give you ownership interest as long as you're here. Where that comes into play, a couple things. You're participating, that employee is participating in profits, and should we sell the company while you're here? And maybe that's our goal. Should we sell the company while you're here? You're really going to make out. You know, if you own 25% of this thing and we sell for $50 million, you get 25%. How do I get a value on my company so that I don't have these high unrealistic expectations? I see this all the time. These are common multiples. If I talk about revenue less than $5,000, a common multiple is 1.5 to 3 times cash flow. And I'll explain what that means. If you're in the retail sector, if you're in the service business, if you're in the food business, and you're $5 million or less, you can expect a 1.5 to 3 times multiple on free cash flow. So what's that mean? Let's say I own an accounting firm. We do accounting, we do taxes, we do payroll, those kinds of things. I bring in $1 million. I'm going to be somewhere around the 30 to 35% number, okay, profitability, somewhere around there. So let's say I do $1 million in gross revenue. That's what we brought in. I've got my expenses called $650,000. So I'm $350,000 profitable. Let's multiply that by 3. And I've got just a little over $1 million, maybe $1,050,000. That's what I could expect to get for that company if I'm going to sell it. It's 3 times multiple. For every business, there's what's called a SIC code, an SIC code. That's how you would determine what that multiple is on your company. If you have questions about that, send me your questions. I'm happy to take a look, help you out, give you some direction. If you're in the manufacturing business or the wholesale business and you're $5 million or less annually in gross revenue, that multiple is going to be 3 to 5 times free cash flow. So if I own a fabricating company, I'm out here fabricating metal, and I do all kinds of things from metal erection of buildings, or I don't know, maybe I'm fabricating small one-off jobs. Profitability is higher for that. It's very specialized. You're going to get a 3 to 5 times multiple. If we had the same scenario, grossed $1 million in revenue, and we had $600,000 in expenses, and we had a $400,000 profit, well, I could take that 5 times. That business is worth $2 million. That's what I could expect to sell that for. Same in the wholesale business. Wholesale, bringing it in, moving it out type thing, typically sold before it comes in. Here's where it gets exciting. Let's shift gears here. Let's go 5 million to 100 million. Same business. The difficulty is let's scale. Let's scale and maintain some margin. What I'm talking about is, let's say I've got a business and I'm at $5 million. I'm 30% profit. That means I take home $1.5 million, or that's my profit. Let's scale it to 10 million. Let's say my profit margin shrinks from 30% to 20%. Well, what do I take home? At 5 million, I took home $1.5 million. At 10 million, I'm going to take home $2 million. I'm at 20%. My margin shrunk. So I only make an extra 500,000. And that's why your multiple goes up as you scale. It's a little more difficult to remain profitable. Do your receivables go up? How do we measure receivables? Now we need a quick ratio. How old are the receivables, etc. Let's say you're in the retail sector, service sector, or food. You're in the food business. Those are going to be a 3 to 5 times multiple if you're between 5 and 100 million. Now, instead of getting 3 times, I can get 5 times. If you are in the manufacturing business, you can expect a 3 to a 6 times multiple. If you are in the wholesale business, 2.5 to 5 times multiple. That's how you do a valuation on a business. Your expectations need to be realistic as you look forward. You've got to have some projection of how you're going to get there. What are your sales going to be this year? What are your sales going to be next year? What are you basing that on? It's taking everything into account. The most important thing here is get a value of yourself, and that's knowing what the market is. I think when we're young and starting out, we don't really know. Do we take the first offer that comes along? What is our actual worth in the marketplace? Perhaps people don't start at big salaries because they have no experience. Oh yeah, they went to college and we all did that, right? And we've got some knowledge, but to apply it and have that experience, what's that actually worth? And you find it in the valuation of what the market is willing to pay. Love you guys. Stay safe out there. I'll talk to you soon.